That makes perfect sense for two reasons. First, some of those 82 anomalies were just quirks in the data. Even though the chances of any one person flipping either 10 heads or 10 tails are tiny, if 1,000 people each flip a coin 10 times, then the odds are good that somebody will flip 10 in a row. And yet, the odds are just 50-50 that this apparent expert will manage to do it the 11th time, despite his impressive track record. The same is true for academic research. If enough researchers study stock prices, then some of them are going to find trading rules that would have made money in the past. Trading strategies that fail don't make the news, though, so we don't have a good way to gauge whether or not the ones that appear to be successful really do reflect skill or whether they're just luck. We just have to wait until a few more years pass to see if they continue to work. The second reason that those 82 apparent return anomalies would decline after people learned about them is that easy money always attracts people who want a piece of the action. For example, several scholarly studies published in the 1980s showed rather conclusively that Mondays tended to be bad days for stocks. Maybe it was just bad luck. Maybe it was some underlying economic force that we didn't understand. But it didn't take long for savvy traders to start selling on Friday and buying late on Monday or early Tuesday. All that selling on Friday drove the price down on Friday so that Mondays didn't look so bad anymore. Maybe this so-called weekend effect was a statistical quirk, or maybe it traced to real economic forces. Either way, once the savvy traders acted on this information, the weekend effect pretty much disappeared. This seems to be the case for several other market anomalies. Any deviations from the fair price tend to be small, and they vanish quickly as clever traders cash in. Sooner or later, usually sooner, the strategies are discovered by other investors, and even if they really were good strategies once upon a time, then they don't work anymore. If there's easy money available, then somebody will grab it fast. Let's use the example of the January effect, sometimes called the turn of the year effect. Donald Keim, then a graduate student at the University of Chicago, generally gets credit for discovering this in the 1980s. Keim found that stocks, particularly small company stocks, seem to generate big returns during the first 5 days of January. What do you think investors would do when they learned this? Right. They started making their January purchases in late December before the price increased. They also delayed their December sales until January. That meant that clever investors had to buy even earlier in December or even in November and sell even later in January. Eventually, the pattern should self-destruct. Guess what? The January effect became undependable after it got noticed. Wall Street traders even joked that the January effect occurs on Thanksgiving now. Now it's time for a joke of a different sort. A professor and his student take a stroll. The student sees a $100 bill lying on the ground. As the student starts to pick it up, the professor says, "Don't bother. That $100 bill can't be there. If it were, then somebody would already have picked it up." Most people use this story to show how stupid the efficient market hypothesis is. I see a different lesson. Really, how many times have you found a $100 bill? I'll wager the answer is not very often, if ever. What's the point? The point is that there probably really is a $100 bill out there somewhere, but it doesn't pay to go out looking for it. There's probably an underpriced security out there somewhere too, but it probably doesn't pay to go out looking for it either. Professor John Cochrane of the University of Chicago raises another subtle point about trying to beat the market. Remember, when I say beat the market, I mean beat the market after adjusting for risk. If you're willing to have a lot of bad years and really take a financial beating every so often, then you can load up on risky assets and probably have enough good years to beat the average market return over the long haul. But that doesn't make you a good investor. That means that you can handle lots more